Okay, good afternoon, everyone. Welcome to today's session. Today is the 26th of June, 2021. Today we'll be talking about investment property in line with the requirement of IAS 40. And if you have watched our last session, that is some session video on property, plant and equipment, the aspect of the property extension to it is what we'll likely be discussing here with respect to investment properties. We'll be able to demystify how investment property differ from owner-occupied property, or what we know as property under IAS 16. Okay, and we are also going to look at areas where they share one or two things in common, and also look at situations where it can be switched between a property that is owner-occupied switching to become an investment property, and vice versa, and what will be the implication of such. Now, the first thing we need to ask ourselves is to understand what is investment property. Now, investment property from the requirement of the standard IAS 40 is made known to be property which could take the form of a land, and it could also take the form of a building. And it can be both, which is land and building. And the standard also recognizes that it can be part of a land, and likewise, it can be part of a building, which means investment property, first of all, by nature, relates to land, or relates to building, or relates to both. And it's not compulsory or necessary that it must be a whole land. It could be part of a land, and it could be part of a building. And what is unique about it in substance is that, be it a land or building or both, which could also be in fact, are held to earn rental income, or are held for the purpose of capital appreciation, or are held for both rental income and capital appreciation. And in the nature of it, the rental income that is derived from it, or the capital appreciation derived from it, is such that is what is expected with respect to the deployment of that property. And it does not take into cognizance such property that might have been used materially or significantly in production or supply of goods and services, or for any form of administrative purposes. Neither will it be property that is developed in the ordinary course of business for it to be sold. Why? For property that is put materially in use for production or supply of goods and services, or for administrative purpose, will automatically qualify as property under IAS 16, which is known as owner-occupied property, which is a business property for its own use administratively or for production. Secondly, property that is developed for the sole purpose of selling in the ordinary course of business will qualify as inventory, because the objective of such property development is to develop and sell. And that does not qualify as investment property. We then make us to reach a summary to say investment property is only restricted to property, be it land or building or both, that is held primarily to earn rental income or for capital appreciation, or where available for both rental income and capital appreciation. Okay, the next thing we need to also understand is when we say owner-occupied property, these are property that is held primarily by the owner for administrative purposes or for production or supply of goods and services. And that will have fall under PPE, under IAS 16. Okay, now let's look at some other key terms that are essential to our discussion on IAS 40. One of them is fair value. Now remember, we've discussed extensively when we are discussing on financial instruments, IFRS 13, we talked about fair value measurements, where fair value has been defined as a price that would be received to sell an asset or the price you will have paid to extinguish or transfer a liability in an orderly transaction, which is expected to have been carried out between market participants at the measurement date. Okay, which speaks to the fact that fair value is a price that reflects what it is at the time you are measuring it, which usually, for accounting purposes, at the reporting date. Now, cost also is critical here. And the reason why is because when we get to subsequent measurement of investment property, we'll make realize that there are two methodologies that serve as an alternative that can be deployed by company in accounting for investment property. And those two methodologies are the fair value model and the cost model. Now, lastly, we'll talk about carrying amounts. Now, what is carrying amount? Carrying amount is simply the amount that is reflected or recognized for an asset or liabilities for accounting purposes, which can also be seen as the amount at which an asset is recognized in your balance sheet or your statement of financial position. These are terms that I believe over time we have been familiar with. And where we are not familiar with them, we've also more or less tried to expatiate on them. But with this little introduction, let us try to understand. Can we give vivid examples of investment properties? Let's look at practical examples of investment property based on our experience or what we might have come across before now. What are the examples of investment properties? Who can give me an example?
Okay, what is the example? I don't know, but basically, from my own experience, when I work in the insurance industry, most of our assets, our properties are classified as investment properties. So as we said, most of them we earn a rental income on them. And some of them, hello?
I can hear you.
So we earn rental income on them. And every year, we value them by valuers. And any gain on it, we take them to the P&L directly. So, and those properties are not, as you said, we don't use them for our day-to-day production. Some of them are occupied by tenants. Some of them are just there. At the end of the year, we just value them to see if there's any appreciation on them, and we'll take it to P&L. And we have a variety of many of them all over the country. So I think it's, I don't know how to give an example, but I think that's the experience I have about the investment properties.
No,
so, but basically,
giving more than practical example.
Hello?
I said you're giving more than practical example.
Okay. So in addition to that, we also have there's some properties. We have branches, and then those branches, those properties, we actually use them in the course of business. Our branches are there in other states, but there are some parts of those properties that are actually let out. When they are let out like that, those income from them, we don't regard them as investment income. We'll take them as rental income from our PPE. So we differentiate them from the income from investment properties and the income from rental properties on PPE. So there are two categories. And
obviously, the rent you're talking about, just now, is it, what kind of property is the rent coming from?
And so the investment properties, those properties that are investment properties, the rent that come from them, recognize them as rental income from investment properties.
Yes, okay.
But there are some rents that come from those properties that we actually use as branches. Those ones are not part of, they are part of our PPE. So we have a property, for instance, in Ibadan, that we have a particular branch there. And maybe the branch, you just decide to, okay, let us save costs, let us sublet a portion of that property out.
Yeah. You got it.
So that is, so those are the two categories, and that's my own practical experience in terms of investment property.
You said it all. On the premise of that, so that we don't waste more time, you've demonstrated that understanding. Now let's look at practical examples. One of those examples are situations where you acquire land strategically with the hope that development is coming to that place. And the intention is to sell over a long period of time. But again, take note, these are not land that you buy on a piecemeal basis or on a short-term basis where you immediately sell. No, these are strategic long-term investments in land for the sole purpose of capital appreciation, especially when development moves to that area. Okay, another example is a building owned by a reporting entity, and it is leased out under an operating lease as being the lessor in that case. Do you get what I'm saying now? And in that situation, you own a property, and the only thing you do with that property is what we just discussed now, that you let it out solely. You are not occupying it, but just to have rental income. Another one you could add is a situation where a parent company has a property and it leases it out to the subsidiary. It's still an investment property if the parent does not make use of it for any administrative purposes other than letting it out to subsidiary. That is investment property from the perspective of the parent alone. But when you now come up as a group, it's no longer investment property, because as a group, you are now one. It is now owner occupied. And what you do at that point in time is that you reverse the status upon consolidation and make necessary adjustment to reflect it back at as owner occupied property. The final one is this. Imagine you are developing a property, and by nature, that property, you have not decided whether you make use of it for administrative purposes or you will let it out solely or use it for capital appreciation purposes. You have not made such a decision. What the standard presupposes is that the first thing that comes to the mind of any individual is that when you develop a property, you expect to recover more value from it than how much you are spending. Therefore, invariably, if there's no intention yet agreed, the minimum intention of anybody is to make capital appreciation from such property, or at least make rental income in order not to keep it idle. And on that premise, the standard resolves to recognizing properties that are being constructed or developed for future use as an investment property. Does that make sense to us? Now, let's see if it actually made sense. Let me give you a question, and let's see whether we'll be able to confirm whether it's investment property or not. Richco owns a piece of land. The director has not yet decided whether to build a factory on it for use in his business or keep it or sell it when the value have risen. Would this be classified as investment property under IAS 40? Who will give us a guidance there? Who will give a guidance?
You said it all. That was you said we classify it as investment property because to take advantage of the capital appreciation in it, since we've not actually decided on what to do with it. So basically, uh, so when it's value, so we classify it as investment property in this case, since we have not decided on what to do, and
Any time
recognizing.
with you?
Okay, I have a little bit of my opinion is a little bit different from that of Enaro, because from this I think it's clear the directors have not yet decided whether to build a factory on it for use. So since there's still a bit of contemplation, so we can't say emphatically that this land is meant for capital appreciation. So at this moment, while the director still vacillates on what to do with it, it should be classified as PPE rather than investment property.
Okay, your position then contradicts my explanation. Let's put it like this. Let's assume that you are being given a land and the land they gave you, you have not even decided on what you do with the land, whether to develop it, build it, and start to make use of it for your own occupancy, or to build your office, or whatever it is. Or you develop that land so that you use it to rent. You let it out, whether you let it out as a raw land, or you build on it and you let the apartment out, or you just leave the land there with the hope that since there is Dangote refinery being constructed around that Lekki area, the land will appreciate in value, and at that point I will sell. Which means when you look at it, what is more probable to occur is for you to be able to harness capital appreciation, which is your immediate value you can get, than putting it to use. Does that make sense?
Yeah.
Because if actually it's more probable that you use it, there will have been intention, there will have been concerted effort towards doing something. Am I making sense, sir? And that's what we need to understand here. But let's see what has happened. I want you to, because you are the one that brought about a twist to it. Let's see what the position is.
Okay, yes, if an entity has not determined that it will use the land either as owner-occupied property or for short-term sale, in the ordinary course of business, land is considered to be held for capital appreciation.
Does that make sense, sir?
It's okay, sir.
I don't just want to tell you what the standard says, but let us look at the rationale behind it, the economic justification or commercial substance on it. Now let's look at various accounting implications, which is what I've discussed earlier. When a particular property might qualify as property under IAS 16, or it qualify as inventory under IAS 2, or actually is an investment property. And what standard governs such accounting? Okay, now let's look at it from this perspective. And I want Anna Grace to volunteer in this respect. Let's look at this accounting implications.
Accounting implications. IAS 40 investment property prescribes the accounting treatment for investment property and related disclosure requirements. An asset held by an entity as a right of use asset under IFRS 16 and leased out under an operating lease is treated as investment property. IAS 40, paragraph 8. You now know what is an investment property under IAS 40. Below are examples of items that are not investment property. Type of non-investment property and applicable IAS. property intended for sale in the ordinary course of business. The applicable IAS is IAS 2 and inventory. Property being constructed or developed on behalf of third parties. IFRS. The applicable IAS is IFRS 15, revenue from contracts with customers. The last one, owner occupied property. IAS 16, property, plant, and equipment.
Okay, thank you. Now let's look at a situation where we have owners occupied property that has a part of it to be an investment property or vice versa. That is, in principle, you have property that in part qualifies as owner occupied and in another part qualifies as investment property. What do we mean by that? Now, let's say, for example, the example Enaro gave with respect to the fact that they had branches that they've occupied it significantly, but in the decision to reduce cost, they now felt that, okay, instead of wasting more space, we can still let out some space and maximize the other space we use. And in that case, we let out a small space that does not represent more than 10 to 20% of our space. And we still earn rentals in it. The question then is this: can we say in such an instance, the space they occupy is owner-occupied property, and the space they lease out is investment property? Okay, it's going to be dicey, but there's a guidance. The guidance is this: we can only consider that property to be in part owner-occupied and in the other part investment property only if the parent, the entity in this case, by nature, do not necessarily occupy significant portion of that property, such that it will have negated the principle that is partly investment property and partly owner-occupied for administrative use. Which that means that if you look at the quality of it, by nature, you find out that significant part of the property from what Enaro gave is used solely for the administrative purpose of the business. Therefore, that insignificant part that is occupied for renters will not have necessarily qualified to be recognized in part as investment property. And therefore, that will be a dicey situation. But what the standard recognizes is that a situation where you have part of a building or part of a land used for administrative purposes or production of goods or supply, and part is used for rentals or capital appreciation, certain conditions must be met. One of those conditions is that by nature, is it practicable for the owner to be able to sell the other parts separately from the other parts, whether as land or as building? Probably it will be possible if you look at the way people build properties now in form of estate property. Probably is detached, and you can sell a particular property separate from the other one. Even for the semi-detached, it is possible you can sell it separately. Even for terrace, it's possible you can sell it separately. Which that means if such instances is more or less observed, we can easily say yes, there's a part that qualifies as investment property and there's a part that qualifies as owner-occupied property. And likewise, the portion that is occupied, whether as owner-occupied or investment property, should not be insignificant. Otherwise, it will have negated the whole principle. Therefore, on that premise, what does the standard say? I want somebody to volunteer to read what the standard says.
Property that in part qualifies as owners occupied property and investment property. Some properties may be partly owner occupied and partly held as investment purposes. For investment purposes. Under IAS 40, if these portions could be sold separately or leased out separately under a finance lease, an entity should account for the portions separately. If the portions could not be sold separately, the property is investment property. It is investment property only. If an insignificant portion is held for use in the production or supply of goods or services or for administrative purposes, that is, if only an insignificant part is owner occupied. Property held for more than one purpose. In circumstances when property is held partly for capital appreciation and or rentals and partly for production of goods or services or administrative purposes, the two parts are accounted for separately if they could be sold or leased out under a finance lease separately. If they could not be sold or leased out under finance lease separately, the property is accounted for as an investment property only if an insignificant portion is held for use in the production or supply of goods or services or for administrative purposes. IAS 40, paragraph 10. IAS 40 does not include any guidance as to what constitutes an insignificant portion for this purpose. This is a deliberate omission. The basis for conclusion on IAS 40 explains that quantitative guidance has not been provided because the board concluded that such guidance could lead to arbitrary distinctions.
Thank you. Thank you. Now, let's also look at this. Can we say a property that you have developed and you have let out or you've leased out qualify as investment property if you, as the landlord or the owner, is still engrossed and an active player in providing ancillary services to the occupants of such a property? Can we consider that such property is an investment property? Now let's look at the position of the standard with example, and I'll provide additional guidance.
Okay. Ancillary services. If an entity provides ancillary services to the occupants of its property, the property is accounted for as investment property, provided that the services are an insignificant portion of the arrangement. Services provided by the owner of an office building. For example, if the owner of an office building provides cleaning services for the lessees of the building, and those services are insignificant in the context of the total arrangement, the building is classified and accounted for as an investment property. It would be unusual for cleaning services to be so material that they would prevent a property from being classified as an investment property. A similar conclusion is likely for security and maintenance services. At the other extreme, some entities rent out fully furnished offices, including a whole range of services such as IT system and secretarial services. Such arrangements are in the nature of the rendering of a service rather than property investment, and the property will be classified as owner occupied and accounted for under IAS 16. However, there are many instances in between these extremes for which the appropriate classification can only be determined based on a detailed assessment of the arrangement and whether or not the services provided are judged to be insignificant.
Thank you. Now, what are we saying in this arena? We are saying that mere providing services, such as cleaning services, security services, is more of you maintaining your property so that it doesn't get decayed or misused. Therefore, in that case, such services is not a material component of earning your income with respect to investment property. Therefore, that will never be a basis of disqualifying it as being investment property. But there's a clause there. You need to observe that today we have some property developed that provides what we call workspace, co-sharing. Do you know what I'm saying now? Can you say such are investment property by their nature? I'll say no. They are more or less like what you develop as owner-occupied that you use for production of services, where people now come to share office spaces and some other things for other purposes. Similarly, let's look at property where you develop, which is not common in Nigeria, but is common in the Western world, especially in UK or Europe, where you have what we call property you develop that is not hotel, neither is it an apartment, but it's more or less like you develop them where it is more or less a service flat. And the nature of it is that people can use them for shortlets. Tourists will come for 7 days instead of going to hotel and all sorts of things, and you provide all forms of services, including beyond auxiliary services, including services that goes to the extent of leisure and some other things. Therefore, the question then is, such will not qualify as investment property because materially you have developed a service which is the main purpose to which you have developed that asset to support in order to earn revenue. And in that case, such will be treated as owner-occupied, similar to how hotel will have more or less treated their property as PPE in that regard. Does that make sense to us?
Yes, sir.
Okay, now let's look at a situation where properties are leased to other group members, which I mentioned earlier. A parent leases property to subsidiary, or a subsidiary leases property to the parent, or another subsidiary leases to another subsidiary. What would that be in all respects, in addition to what I've said earlier? Can somebody volunteer?
Okay, property leased to other group members. If an entity owns a property that is leased to and occupied by another group member, e.g. a parent or another subsidiary, the property is not recognized as an investment property in the consolidated. The property is not recognized as an investment property in the consolidated financial statement because it will be treated as owner occupied from the perspective of the group. However, from an individual entity perspective, the property is treated as an investment property if it meets the definition of IAS 40, paragraph 5.
Okay, thank you. That corroborated what I've said earlier. Now, also, let's look at a situation where a group of assets leased under a single operating lease. What effect does that have with respect to what we've discussed? I want Enaru to assist us in this discussion.
Group of assets leased under a single operating lease. Example, IAS 40 section 5 states that in determining the carrying amount of investment property under the fair value model, an entity does not double count assets or liabilities that are recognized as separate assets or liabilities. For example, A, equipment such as lift or air conditioning is often an integral part of a building and is generally included in the fair value of the investment property. Rather than recognized separately as property, plant, and equipment. B, if an office is leased on a furnished basis, the fair value of the office generally includes the fair value of the furniture because the rental income relates to the furnished office. When furniture is included in the fair value of investment property, an entity does not recognize that furniture as a separate asset. Consider the following example. A lessor leases out a farm for the purpose of earning renters. The farm is made up of the following assets. 1, land and agricultural buildings. 2, agricultural fittings, features, and machinery that are an integral part of the agricultural building. The lease agreement meets the definition of an operating lease for the lessor, and the lessor measures investment property after initial recognition at fair value. The lessor should account for all the assets included in the operating lease agreement as a unique investment property, and as its consequence, measures it using the fair value model.
Okay, thank you very much. Now, what that supposes is this. When you say this is an investment property, every ancillary fittings, equipment embedded in that property may be treated as a whole, especially if they are integral part of that property, in order to satisfy the purpose of being an investment property that is for renters. And in that situation, when you fair value the investment property, you are not just fair valuing the property as a standalone, but you are fair valuing other component parts that make it satisfy that condition of investment property. And in that situation, they will be fair value as a whole. Okay, and that is that. Now, secondly, if you have a lease, if you are a lessee, in a lessee, you have right of use, okay? And by nature, the property you have right of use on, you didn't use it for your administrative purposes. Rather, you now use it for investment property by letting it out to somebody else solely to generate rent. In this case, you won't talk of capital appreciation because you don't have rights or ownership over it to dispose. But you lease it out to generate rental primarily without you occupying any portion or significant portion in it. Now, you get to understand later that when you are to fair value it, the question is, are we to fair value the property itself, or are we to fair value the right of use of that property? But these are questions we are going to discuss. And I make mention of this because of the example we have also given, in which investment property might also be a creation of a lease arrangement between the lessee and a sub-lessee in respect. And we're going to see that as we move on. Now, let's now look at, since you've now been able to identify what we know as investment property, the question then is, at what point do we recognize investment property as an asset in the books of the entity? There are two conditions that the standard expects us to meet. And the two conditions include that, one, you must be able to establish that it is probable that future economic benefit is expected to flow to the entity as a result of ownership or as a result of holding control over such investment property. And secondly, the cost of holding such an investment property must be able to be measured reliably. And upon meeting these two conditions, you are to recognize investment property in your books. The question then is, what will be the value to which you recognize investment property in your books upon initial recognition? At what value are you going to measure your investment property at the point of you recognizing it in your books? Can somebody give me an idea?
So at initial recognition, I think investment property should be recognized at costs, which include the cost of the asset itself and maybe the cost of bringing the asset to the point of use should be recognized. I mean, should be the cost at which it is recognized.
Okay, which means your principle is somehow in tandem with the recognition principle for property under IAS 16.
Yes.
Will I be correct if I say that?
Yes.
Okay, which means incidental costs or transaction costs associated to holding such investment property will also be considered. And that is from the perspective of you being the owner of that property, by you acquiring that property. What if you are a lessee in that regard? You lease that asset, which you converted to investment property. How will you measure such? Given that we have discussed and we've had in-depth understanding of IFRS 16 on leases, what do you believe would be the appropriate basis to recognizing the right of use of an asset by a lessee, which has now been used solely for the purpose of being classified as investment property?
So if I may speak to that, I think you have to look at all what you have to pay regarding the lease, like the cash flows that are associated with the lease, and then discount it to the present value. That will be the amount you recognize.
Okay, that means, simply put, you are right. But to summarize it or to simplify it is that you defer to the requirement of IFRS 16, which is the requirement you just disclosed, that you recognize it be the cash price you have paid at the point of commencement plus the present value of future payments, lease payments you have to make, and other incidental costs associated with it in compliance with the requirement of IFRS 16. And similarly, for owner of entity-owned investment property, in that regard, it will be measured at cost, including incidental costs, which are direct and indirect costs associated with the acquisition of such a property. Now, I told you earlier that subsequently, if we are to measure investment property, there are two models that are key, and they are mutually exclusive. Who can remind me of those two models?
Well, one, I think if we are going to, we have the revaluation model. That's one, and two is the valuation model flowing from the fair value at every reporting date. The second one is the cost model. I think those are the two.
Okay, I'll agree the cost model with you.
I think the second one should be fair value. Revaluation model.
Yeah, fair value model. Remember, when we started the
I
section,
said so now. I said the revaluation model which will flow from fair value and cost model. That's what I said.
The evaluation model cannot flow from fair value. They are two separate models.
Okay.
They are two separate models, and I will explain. That's why I said today we are going to discuss extensively those areas of commonality and those areas of difference between IAS 16 and IAS 40. Remember, when we are defining this, I emphasized on the reason why I have to refer to these two definitions because they serve as a model to be adopted subsequent to acquisition. Okay, now, cost model is 100% in tandem with cost model under what? IAS 16. Therefore, we won't be discussing cost model in its real sense because everything about the cost model is exactly the same cost model of IAS 16. Even the standard defer to IAS 16 for more reference so that you don't duplicate things. Dig up here now. Now, fair value model. Let us first of all, let me ask you this question. Can we conclude that the revaluation model of IAS 16 is the equivalent of the fair value model of IAS 40? Who will answer that question? And let us know areas of, if you agree, tell us why you agree. If you don't agree, tell us why you disagree.
For me, I will say revaluation model. Yes, of course, they are the same thing, it's just different version because there are two different
And what do you mean by
standards.
version?
Yeah, okay, the fair value model for the IAS 40 it accommodates any increase it accommodates any appreciation in the assets which you take to your P&L. Then the evaluation model also accommodates any increase in the value of the assets, and any gain on it, you take it to your OCI. But basically they are the same. That's why I see it.
Okay, who will contradict
For
what
me
they are saying?
to like making distinction between the two is still very, very difficult. I must be honest with you. But I think it has to do with what goes into the P&L, what goes into the income statement. Like revaluation model, we all know that any increase in value or decrease in value will affect either the P&L or the OCI, depending on how the flow is. But in terms of fair value, when an asset is fair valued, I think it will only be recognized on the balance sheets, and I doubt if anything will go into the P&L.
So it goes to P&L if it's fair valued under IAS 40. Everything, either loss, if it increases, it goes to P&L. If it decreases, it goes to the P&L as well. So it's only the revaluation that either goes to P&L if it's a loss, or to OCI if it's a gain. So
who else can assist from the class? Tomilayo, are you there? Madam Grace, can you be an umpire? Madam Grace, can you be an umpire? Okay, let's look at areas of commonality. Both will recognize the value of the assets at current value. If you refer back to conceptual framework, in the conceptual framework, we recognize that there are two models or basis of valuation or measuring asset and liabilities: cost model and the current value model, where the current value model could be fair value, could be present value, which will give the value in use for an asset, or fulfillment value for liability, and the third is the current cost to make up current value. Now, fair value model and evaluation model will necessarily give the same value to be recognized at the reporting dates for the investment property, recognizing such an increase. But they have more differences than what is common between them. One of those differences is the revaluation gain or gain arising from evaluation of an investment property, of a property, owner-occupied property, will be reported through other comprehensive income, if you remember what we discussed under IAS 16. Whereas fair value model of IAS 40 requires the recognition of fair value gain in profit or loss, which is in consonant with what my brother said earlier. And now, when we started the class, when you talk about your company, I think insurance company who has more investment property, and every year you carry out valuation and the fair value gain or loss goes to your profit or loss. And that is a fact. That is one. Two, there's no revaluation loss in real sense. Rather, what you have is that whenever you do revaluation and it seems to be lost, it becomes a trigger for you to subject it to an impairment test. Which means when you see a reduction in valuation, it's going to be tantamount to subjecting that property to impairment test. And where you've so found that the recoverable amount is lower than the carrying amount, you recognize impairment loss in line with IAS 36 for owner-occupied property. Okay. And such impairment loss goes to profit or loss or goes to other comprehensive income based on the fact that it might have initially recognized revaluation surplus or gain. And that is in tandem with what we have discussed before now under IAS 16. But when you come to investment property, one, there can be fair value loss, there can be fair value gain. Either fair value loss or gain is reported in profit or loss. Two, if you have used the cost model, that's only when you subject investment property to impairment. But when you use fair value model, you don't subject it to impairment at all. The third thing that is so obvious is that asset that is revalued or that is subjected to revaluation model of IAS 16 will still be subjected to depreciation once it doesn't have an indefinite life or indeterminate life. But assets, investment property that is measured at fair value model under IAS 40 will, for no reason, be depreciated. I believe you heard me. For no reason, will it be what? Depreciated. And I'll try to give you, I'll put something up here to substantiate that. Yeah, let me just put it somewhere here. Can somebody read it out? Can somebody read it out?
Okay, investment property under fair value model is not depreciated. Once the entity opts to use the fair value model, it should be used for all the investment properties, except the investment property for which fair value is not available under specified circumstances.
Yes, or investment property that is carried at what? At cost, which is this cost model. Take notes. And again, one thing you need to take notes, which I emphasized, and I think it's what I emphasize at every point in time, is that when there is a policy to be adopted by way of choosing a method, you must ensure that at every point in time, what you choose is what you follow consistently. And in this case, policy that you have applied for one investment property affects all investment properties. And we're going to see further things. We're later going to see exceptions to that, okay? And the exception is not that you are not carrying it at fair value model, but because there's a temporary inability to reliably measure it at fair value. Therefore, you can devote to carrying it at cost, but thereby you will subject it to an impairment test. Okay, any question before I move further?
Okay, my question is this. The carrying this carrying investment property, is it? I've not come across a situation where a company carries investment property at cost, and if it does happen that a company carries, an entity carries investment property at cost, what rationale would that be for them to carry it at cost? Because in that case, they would not take advantage of capital appreciation in landed properties. That is my question.
Okay. I think what you are trying to say is that what is the commercial substance of you not picking a cost model? Okay.
Of you not picking a fair value model.
Of not picking a fair value model. I understand. Yeah. Okay, yeah, you might be right, but you must also understand that not recognizing it at cost does not change the fact that you also will benefit from such capital appreciation upon disposal, which means what you have not recognized over time, you will recognize it only upon disposal, which it doesn't deprive you of the commercial substance of you holding such an investment property. But remember, the standard I've told you, you have two options. No matter how you view the other option, there is still a rationale that may be in tandem or in consonant with the strategic objective of that particular entity. Yes, it might not be what is prevalent, but it is also what is known that entities may adopt cost model for its investment property. But the standard make a condition. If you have chosen the cost model for your investment property, you must always, in your note, disclose the fair value of that investment property. Does that make sense, please?
Okay, yes, it does. In the notes. Okay.
Which means at every point in time, you still disclose it, only that you will not recognize it. And it is not left for users of financial report to make informed decision on it. Now, as I've said earlier, let us look at all what I've said that I've tend to explain the fair value model.
Sorry, just a moment.
Yeah.
Now, in that case, for a very small organization that does not have the resources to engage valuers every year, in that case, they may, because of that consideration, they may opt for the cost model. But at the same time, they may not be able to actually have the fair value in that situation in that situation. I don't know what you get what I'm saying.
No, I got it. And you also have expatiated it. That even when you are going to use cost, you still carry out fair value measurements, only that you not recognize it, which means that is not an excuse. Now, again, you've mentioned something which I'll make you know. Probably at this point, I'll show it. The standard does not mandate you to use an expert for investment property, which means you can do internal assessment if you have the expertise. You don't need to have independent valuer. But sometimes in some jurisdictions, regulation of those jurisdictions may warrant you to use a professional so that you don't distort your financial position. Example of such jurisdiction is Nigeria. In Nigeria, to a high degree, Financial Reporting Council of Nigeria will prefer or will require you to use a certified valuer for any such fair value on investment property or on some other key specialized asset to be certified by an independent recognized expert that is equally registered with FRC for it to be recognized in your books, whether by way of disclosure or by way of accounting. And therefore, that is Nigerian perspective. But in most Western world, it might not be something that is compulsory. But again, I won't see where the cost of valuing investment property will be materially different, because what do you value? The land component of it has no difficulty in valuation, because what you look for is the rateable value, what the land is going for in that environment, which is a public information. Two, the property valuation is always based on certain valuation metrics, based on what we call the International Standard on Valuation or International Valuation Standard, IVS. You understand? And it has metrics whereby if you already have your measurement and some other parameters, you can equally estimate the value and find the present value of it or whatever it is. You understand? It's not going to be, I don't see it as more of rigor or more of bottleneck or challenge in adopting the fair value model, even by a small entity. And again, as a small entity, your investment property will not be that sophisticated that will have required a humongous amount to value. I think I've made sense in that.
Yes, sir.
Okay, in that light, I want someone to take us through the fair value model in order to summarize all what we've discussed prior to now.
Okay.
Stop. Fair value model. After initial recognition, an entity that chooses the fair value model should measure all of its investment property at fair value, except in the extreme rare cases where this cannot be measured reliably. In such cases, it should apply the IAS 16 cost model. A gain or loss arising from a change in the fair value of an investment property should be recognized in net profit or loss for the period in which it arises. The fair value of investment property in accordance with IFRS 13 should reflect market conditions at the end of the reporting period, IAS 40, paragraph 3, 35, and 40. This was the first time that the IASB allowed a fair value model for non-financial assets. This is not the same as revaluation, where increases in carrying amount above a cost-based measure are recognized as revaluation surplus. Under the fair value model, all changes in fair value are recognized in profits or loss. The standard elaborates on issues relating to fair value. Fair value assumes that an orderly transaction has taken place between market participants, i.e., both buyer and seller are reasonably informed about the nature and characteristics of the investment property. A buyer participating in an orderly transaction is motivated but not compelled to buy. A seller participating in an orderly transaction is neither an over-eager and over, sorry, where was I think I've missed my line, is neither an over-eager nor a forced seller, nor one prepared to sell at any price or to hold out for a price not considered reasonable in the current market. Fair value is not the same thing as value in use, as defined in IAS 36, impairment of assets. Value in use reflects factors and knowledge specific to the entity, while fair value reflects factors and knowledge relevant to the market. D. In determining fair value, an entity should not double count assets. For example, elevators or air conditioning are often an integral part of a building and should be included in the investment property rather than recognized separately. When a lessee uses the fair value model to measure an investment property that is held as a right of use asset, he shall measure the right of use. Hello? Okay, he shall measure the right of use asset and not the underlying property at fair value. F. In those rare cases where the entity cannot determine the fair value of an investment property reliably, the cost model in IAS 16 must be applied until the investment property is disposed of. The residual value must be assumed to be zero. When lease payments are at market rates, the fair value of an investment property held by a lessee as a right of use asset net of 4 expected lease payments should be zero. IAS 40, paragraph 50 to 55.
Now you can see how all of what we discussed more or less is corroborated by the position of the standard. Now we'll compare that with the cost model. And you see the reason why the cost model is not going to be discussed extensively here. Why? Because it's what we have discussed extensively under IAS 16. And what the standard has done is that it has deferred to the entire provision of IAS 16 with respect to making use of the cost model for investment property. In that light, Madam Grace, I want you to discuss on the cost model. We can't hear you.
Hello, sir.
Yes, okay.
Yeah, you said you want me to discuss the cost model.
The cost model, yeah, it's projected. Just read it out for us to corroborate what I've discussed.
Okay. Cost method through cost model. The cost model is the same as the cost model is the same as the cost model in IAS 16 for owned assets. Assets held by lessees as rights of use assets are measured at cost in accordance with IFRS 16. Investment property should be measured at depreciated cost, less any accumulated impairment losses. An entity that chooses chooses the cost model should disclose the fair value of his investment property. IAS 40, paragraph 56 and 79.
Okay, now, thank you very much. Now, let's now try to look at the change of model from one model to the other. First.
Sorry, please, just one question. I just saw something. I saw depreciation there. Does it mean that investment property measure at cost will also be depreciated?
Yes, I think that's what when I was giving you the differences, I narrated it one by one. That investment property, once you use cost model, what you are simply doing is that you are more or less treating it exactly the way you treat property under the cost model of IAS 16. The only thing in addition to IAS 16 is that you now have to disclose the fair value of that property. And I said you have to depreciate it, and you have to even subject it to impairment test. But when you choose IAS 40 fair value model, one, you will not depreciate. Two, you will not test for impairment because the fair value loss or gain has taken care of what you need to do at any point in time. Does that make sense, sir?
Yes, sir. So, but this is quite no. Just looking at it, that when something is depreciated, you depreciate to the residual value. So an asset that is investment property that we have seen as head for capital appreciation, then it's depreciated to just the residual value.
Now, why do you depreciate the residual value? Because you expect that is the value of the asset over time. The same thing if you have chosen fair value model, if the asset has lost value over time, up to what it would have been if you have used cost model, the fair value will have also pointed to that same direction. By the time the valuer comes, the building is already becoming old building. Such building is now building that cannot last for more years other than for you to pull it down. Do you understand? All those things will be factored into the process of valuation to bring it close to that value of writing up, building up. Are you getting what I'm saying now?
Yes. Okay.
So nobody told you that fair value will be going upward forever or will remain constant. We have seen company share price that have gotten to 14 naira and later now they are 2 naira. And it's still fair value.
That's true.
Therefore, it means it is reflecting the current economic information and other information integral to that particular asset. Does that make sense now?
Yes, sir.
Now, I have a question.
What is that? Yes, sir.
I have a question, sir. Yeah, in case you have a building in the choice area, maybe for instance in Lagos, like Allen, and there is constant maintenance of that building. In that case, it will valuing such an asset may not be coming down as expected. I don't know if you get what I'm saying.
That is reality now. You are enhancing the value.
Yeah.
Which the reason why the fair value is going up is the enhancement, which is additional cost.
Yes.
That has also created inherent value. Therefore, we are saying the same thing.
Okay. All right, sir.
If you have used cost model, those enhanced costs will have been part of your capitalized cost or addition or improvement. Does that make sense?
Yes, got it, sir.
And again, even at cost model, in IAS 16, you can still use evaluation model, which means recognizing it up, only that you subject it to depreciation. And the fair value gain or evaluation gain goes to other comprehensive income rather than go to profit or loss. Now, let's now pick on a critical point here. Can I change from cost model to fair value model? The standard recognizes that you can. And can I change from fair value model to cost model? The standard also recognizes that you can. But it's more often to see you change from cost to fair value model than from fair value model to cost. But there are instances that provide genuine change from fair value to cost. especially where there is no reliable basis to be able to measure at fair value. That's one of those reasons. But again, the standard make a conclusion that the only reason that is acceptable to changing a model, whether cost to fair value or fair value to cost, is on the premise that such a change will rather provide more reliable and relevant information that will serve as an input to sound decision-making by the stakeholders. If there's no evidence to demonstrate that the reason why you are changing the model is to enhance the reliability and the relevance of the information contained in the financial report as regards investment property, such change will not be permitted. And that's the role auditor plays most times to justify whether it is reasonable to agree with management for such a change in methodology. But again, even when you've passed the order of satisfying the condition to bring about the change, there are still implications for those changes. What are the implications? The implications are very simple. One, when you change from cost model to revaluation model, to fair value model, you have to remeasure the value as at the time you are making that transfer from cost model to fair value model. You have to remeasure at fair value. And any fair value gain or loss recognized as a result of difference between the carrying amount prior to reclassification, or sorry, not reclassification in this case, but prior to change the model, and the fair value you carried out at the point of the new model, the difference will be reported in profit or loss. And subsequently, you comply with the requirements of IAS 40 with respect to fair value model. Conversely, if we are changing from fair value model to cost, now the standard also provides to us that the fair value of the property, you understand, will more or less become a default carrying amount, if need be. And that will be recognized. And where there seems to be a lower value in which it has to be recognized, such presumed fair value loss will also be recognized in accordance with the requirement of IAS 16. And what is that? We are going to look at it. Now, let's look at it one by one. I want somebody to look at this and try to make meaning out of it as we move on. Over to you guys.
Okay, once the entity has chosen the fair value or cost model, it should apply it to all its investment property. It should not change from one model to the other unless the change will provide more reliable or relevant information. IAS 40 states that it is highly unlikely that a change from the fair value model to cost model will result in a more appropriate presentation.
Okay, continue.
Transfers to or from investment property should only be made when there is a change in use. For example, owner occupation commences, so the investment property will be treated under IAS 16 as an owner-occupied property. When there is a transfer from investment property carried at fair value to owner-occupied property or inventories, the property's cost for subsequent accounting under IAS 16 or IAS 2 should be its fair value at the date of change of use. Conversely, an owner-occupied property may become an investment property and need to be carried at fair value. An entity should apply IAS 16 up to the date of change of use. It should treat any difference at that date between the carrying amount of the property under IAS 16 and its fair value as a revaluation under IAS 16.
Okay, now what I've said earlier is that that difference from your carrying amount to your fair value when you are moving from cost model to fair value model is tantamount to revaluation of asset under IAS 16. That's why I said you defer to the requirement of IAS 16, which requires you to recognize such gain on revaluation in other comprehensive income. Okay, and that is the position there. Okay. Is that all? Is that all?
Yes, that's all.
Okay. Any question before I bring in some other practical perspective to it? Any question? Now let me give you some practice question. I'll give us time to look at it ourselves and we'll prefer solution to it. I want somebody to read it and I'll give you small minutes to prefer solution and we'll return to discuss that solution. Can somebody read it out? And we'll look at it together.
Okay, a business owns a building which it has been using as a head office. In order to reduce costs, on 30th June 20X9, it moved its head office function to one of its production centers and is now letting out its head office. Company policy is to use the fair value model for investment property. The building had an original cost on 1st January 20X0 of $250,000 and was being depreciated over 50 years. At 30 June 20X9, its fair value was judged to be $350,000. How will this appear in the financial statements at 30 June 20X9?
Okay. Now I'll give you guys a few minutes to discuss it, and thereafter we'll return for me to provide guidance. Okay, let somebody present your suggested solution in this case. Over to you guys.
Okay, so what we did was to look at the number one, the property was depreciated up to 30th of June 20X9. It was purchased on the 1st of January 20X0, and it was carried under IAS 16 using the revaluation model, and it was depreciated for 9.5 years. So when we look at it, the carrying amount as at the date that the property was converted to investment property, it has been used for 9.5 years, and the carrying amount as at that date was 202 when you deduct accumulated depreciation. So, and it was on that date that it was converted to investment property. The revaluation, the carrying amount, when it was revalued, it was valued to 350. So there was a revaluation gain of 147 I can't remember the exact figure, 147,500, and that evaluation gain based on the standard, what the standard stipulates that the day that a property that was carried under IAS 16 is converted to a investment property, any revaluation gain on that day should be moved to the OCI. So that gain on revaluation was moved to OCI. And as of that date, the carry amount became 350,000 as investment property. That is the way we tackled it.
Okay. Now, let's see what they've given to us. Okay, useful life is 50 years. Original cost, 50,000. Original cost, fair value at 30 June 2019. The original cost was as at when? 1st of January 2010. Okay, this 250. And the new fair value is 350. Okay, what else? I think I put all the variables there. Therefore, let us assume depreciation method will have been straight line except otherwise stated. Under IAS 16, straight line. Now, the first step, step 1, is to determine the carrying amount as at the point of transfer was 30th June 2019. Now, the first thing is, how many years? Would the assets, or let me put the word property, been depreciated for? Is for us to look for the date difference. And the date difference, if you use Excel formula, is date diff between acquisition and today in years. That is 9 years, but it's not exact 9 years. Let me check whether there are additional months in it. Let me check if there are months left. Sorry, is YM, not MY. Therefore, it's showing 5 months, but I know that because if I've put, let me put equivalent of July 1st. Let me just add one day to it so that I can show me the exact months, 6 months. Because it will show you by rounding down to the, rather than rounding up. Okay, if you understand it. Therefore, this is in months. Therefore, everything is 9 years, 3 months, which then means that if I do the first 9-year depreciation, nine-year depreciation means 9 over 50 years multiplied by 250. And that should give me this 9 divided by 50 years multiplied by the cost. That'll give me 45. Now, the 6 months, remaining 6 months depreciation will be 6 months is 0.5 divided by 50 years multiplied by 250. Alternative to that is just say 9.5. I'll use the same thing. Now, how do I get 0.5? I'll use 6 months, and 6 months converted to decimal is divided by 12, which will give me that. Invariably, my sum of depreciation of 9 months, 9 years, 6 months is this. Now, what will be the carrying amount? The carrying amount as at 30 June 2019 equals to, all in US dollars, initial cost less accumulated depreciation. What's the accumulated depreciation? Initial cost is 250. Accumulated depreciation is 47,500. Therefore, what is the carrying amount? Does that speak to what you guys wanted?
Yes, sir.
Okay. Okay. That is that. Now, step 2 is to ascertain the gain on revaluation of the investment property, because now we are changing the use to investment property, away from property. And what we do is we compare the fair value compared to the carrying amounts. What is the fair value? 350. What is the carrying amount? 202,500. What is the difference? And that gives me this. Now, the question then is, how do we treat the gain or revaluation at the point of change in use? Who can answer that question? Who can answer it?
We
How
charge
should we treat the gain?
other comprehensive income as revaluation gain.
The sum of $147,500 being the gain on revaluation prior to the class to investment property should be recognized or reported in other comprehensive income. Do we agree? If you disagree, let's say it out.
We agree. That's what we agreed on.
Okay. That is it. I think that made sense. Okay. Let's go back to our notes. Therefore, what did I put there? Can somebody, okay, we don't need to read it out, it's exactly the same thing. Now, let me ask you a simple question. What would have happened if, let me go back to that. If it were to be revaluation loss in this case, let me say this is not 350. Eventually, this is 180. How do we treat this loss? Who will answer?
Okay, I think going by the prudent principle of the conceptual framework, that's what will be taken to P&L direct straight away.
Okay, it will be treated the same way I've said that in principle, there's no revaluation loss. It is a trigger that the asset may have suffered impairment or loss, which means such amount will be treated as an impairment loss, which will be recognized in profit or loss. But if the property itself was carried as revaluation model under IAS 16 before now, and it has evaluation surplus or reserve, such loss will first of all be used to reduce that surplus or reserve to zero, in line with what we have discussed in IAS 16 before any excess above such will be reported in profit or loss. Does that make sense?
Yes.
Now let's look at some other aspect to our discussion as we wrap up. Now let's see practical instances that shows change in use of a property that will have warranted it to be classified as investment property. Can somebody look at it?
Okay, transfer to or from investment property general. An entity should transfer a property to or from investment property when and only when there is a change in use. A change in use occurs when the property meets or ceases to meet the definition of investment property, and there is evidence of the change in use. In isolation, a change in management's intention for the use of a property does not provide evidence of a change in use. IAS 40, paragraph 57. Examples of a change in use include: 1, commencement of owner occupation or of development with a view of owner occupation for a transfer from investment property to owner occupied property. 2, commencement of development with a view to sale for a transfer from investment property to inventories. 3, end of owner occupation for a transfer from owner occupied property to investment property. Or 4, inception of an operating lease to another party for a transfer from inventories to investment property.
Okay, thank you. Thank you very much. Now, there are other salient things that we'll also look at, which are just narrative to support all what we have discussed and to give us one or two guidance or example according to what the standard has provided. And I want Segun to finish with it as we wrap up with disposal of investment property. But let us look at things like subsequent costs. Let us look at things like investment property in the cost of construction. Let us look at things like deferred payment and the likes. Okay.
Okay. Subsequent costs. Appropriate application of the recognition principle set out at 3.1 results in: 1, the immediate expensing of the costs of the day-to-day servicing of a property, e.g. the cost of labor, consumables, and minor parts used for repairs and maintenance, and costs incurred to replace parts of the original property being recognized in the investment property if they meet the recognition criteria. When the cost of replacement parts are capitalized, the carrying amounts of the replaced parts are derecognized. Investment property in the cost of construction. Investment property in the cost of, IAS 40 does not deal specifically with the recognition of the cost of a self-constructed investment property. The appropriate accounting for such property is therefore determined in accordance with general principles. Over the period of construction, the cost of construction will be capitalized as part of the cost of the investment property in accordance with the general principle outlined at 3.1, paragraph 16 to 22 of IAS 16. Provide guidance as to what is appropriately included within such costs. The capitalization of borrowing costs is considered in accordance with the general requirement of IAS 23. IAS 23, paragraph 4 provides an optional exemption from requirements to capitalize borrowing costs for qualifying assets that are measured at fair value, which would include investment property under construction if an entity follows the fair value model for investment property. Therefore, entity can choose as a matter of accounting policy whether to capitalize borrowing costs in respect of such assets. When relevant, please can you scroll up, please?
Okay, no, I wanted to stop at that. Okay, that's very relevant. Now let's look at deferred payments and also what we discussed earlier, the use of independent valuer. Is it actually necessary?
Deferred payments. The cost of an investment property for which payment is deferred is the cash price equivalent of the deferred payments. The difference between the cash price equivalent recognized at initial measurement and the total payments made is recognized as an interest expense over the period of credits. That is the period from the point of receipt of the property until the point of settlement of related liability. There is no definition of cash price equivalent in IAS 40. It is presumably intended to equate to the present value of the deferred payments, but might also encompass a cash price offered by the vendor as an alternative to the deferred payment terms. Use of independent valuers. Entities are encouraged but not required to use as in entities are encouraged but not required to use as a basis for measuring fair value a valuation by an independent valuer who holds a recognized and relevant professional qualification and has recent experience in the location and category of the investment property being valued. The board decided that an independent valuation should not be required under IAS 40 because of the following considerations. The cost-benefit ratio of an independent valuation may be inappropriate for such entities. And secondly, independent valuers with appropriate expertise are not available in some markets. Consequently, paragraphs B55 and B56 of the basis for conclusions on IAS 40 explain that it is for the preparer of financial statement to decide in consultation with auditors whether an entity has sufficient internal resources to determine reliable fair values. Inability to measure fair value reliably. There is a rebuttable presumption that the fair value of an investment property can be measured reliably on a continuous basis. But in exceptional cases, when an investment property is first acquired or when an existing property first becomes an investment property after a change of use, there may be clear evidence that the fair value of the property is not reliably measurable on a continued basis. This arises when and only when the market for comparable properties is inactive, e.g. there are few recent transactions, price quotations are not current or observed transaction prices indicate that the seller was forced to sell. And alternative reliable measurements of fair value, e.g. based on discounted cash flow, are not available.
Okay.
Okay, should I continue?
Yes.
There is a rebuttable presumption in IAS 40 paragraph 53 that the fair value of an investment property can be determined reliably on a continued basis. There is no exception in a period of significant valuation uncertainty, even if comparable market transactions become less frequent or market prices become less readily available. It is only in exceptional cases when there is clear evidence when the entity first acquires an investment property or when an existing property first becomes an investment property after an evidence change in use, that fair value is not readily determinable. That is not readily determinable, that the entity is permitted to measure the investment property at cost while measuring its other investment property at fair value. These exceptional cases are expected to be very rare. Investment property in the course of construction. If an entity determines that the fair value of an investment property under construction is not reliably measurable, but expects the fair value to be reliably measurable when construction is complete, the entity measures the investment property under construction at cost until the earlier of the fair value becoming reliably measurable or the completion of the construction. Once the entity is able to measure reliably the fair value of the investment property under construction, the property should be measured at fair value. Once construction is complete, it is presumed that fair value can be measured reliably. If this is not the case, following completion, the property is accounted for using the cost model in accordance with IAS 16 for owned assets, or IFRS 16 for investment property held by a lessee as a right of use asset under the general requirements of IAS 40, paragraph 53. The presumption that the fair value of investment property under construction can be measured reliably can be rebutted only on initial recognition. An entity that has measured such property at fair value may not conclude that the fair value of the completed investment property cannot be determined reliably. IAS 40, paragraph 53b. Anticipated liabilities. When an entity expects that the present value of the payments relating to an investment property, excluding payments relating to recognized liabilities, will exceed the present value of the related cash receipts, IAS 37 should be applied to determine whether a liability should be recognized, and if so, how the liability should be measured. IAS 40, paragraph 52. Compensation for impairments. Compensation for impairment of investment property. Impairments or losses of investment property related claim impairments or losses of investment property, related claims for or payments of compensation from third parties, and any subsequent purchase or construction of replacement assets as separate economic events and accounted for separately, IAS 40, paragraph 72. Therefore, impairments of investment property are recognized in accordance with IAS 36. Retirements or disposal of investment property are recognized as set out in section 7 in accordance with IAS 40, paragraph 66 to 71. Compensation from third parties for investment property that was impaired, lost, or given up is recognized in profit or loss when it becomes receivable. And the cost of assets restored, purchased, or constructed as replacements is determined as set out in section 4 in accordance with IAS 40, paragraph 20 to 29. Insurance claim, example, a building carried as an investment property burns down during the reporting period. Evaluation of the building in its damaged state is performed at the end of the reporting period. The amount receivable from insurance should be recognized separately in the statement of financial position at the end of the reporting period if it meets the relevant recognition criteria. Any valuation of the property recognized as an investment property should not include the insurance receivable.
Thank you very much. Those are salient things that will more or less goes with investment property. Now, the last one we'll be discussing before we wrap it with disclosure is disposal that brings about the recognition of investment property in your books. Now, and if you are aware, the recognition means you are removing or eliminating the value of such an asset from your balance sheet. And what happens is that such removal is permanent in nature. And what could bring about that is when such has been disposed of. And once it has been disposed of, it could result in a gain or loss that will have to be reported in your profit or loss for that period. And any compensation you expect from a third party from such investment property that will have been impaired, lost, or given up shall be recognized in the profit when the benefit or the compensation is immediately receivable or due from the other party, which means the same way we'll have recognized or the recognized property under IAS 16 is the same fashion in which we would recognize investment property in IAS 40. Now let's look at that and wrap it up with disclosures. Okay, I want someone else to more or less do this read up and we wrap up if there's no other questions or discussions.
Disposals of investment property. The recognize, eliminate from the statement of financial position an investment property on disposal or when it is permanently withdrawn from use and no future economic benefits are expected from its disposal.
You know, disposal could be when you sold off an asset, or could be deemed disposed when you abandon such asset because it no longer have future economic use, which means you have withdrawn it from your economic or commercial usage. Go ahead, sir.
Okay. Any gain or loss on disposal is the difference between the net disposal proceed and the carrying amount of the asset. It should generally be recognized as income or expense in profit or loss. Okay, there's a noise in my background. So just a minute.
Somebody else can continue.
Okay, disclosure. Both fair value model and cost model. Whether the fair value or cost model is used. If the fair value model is used, whether property interest held under operating leases are classified and accounted for as investment property. 3, if classification is difficult, the criteria to distinguish investment property from owner-occupied property and from property held for sale. 4, the extent to which the fair value or investment property is based on a valuation by a qualified independent valuer is, if there has been no such valuation, the fact must be disclosed. 5, the amount recognized in profit or loss for A, rental income from investment property, B, direct operating expenses, including repairs and maintenance arising from investment property and that generated rental income during the period. C, direct operating expenses, including repairs and maintenance arising from investment property that did not generate rental income during the period. The cumulative change in fair value recognized in profit or loss on a sale from a pool of assets in which the cost model is used into a pool in which the fair value model is used. The restriction on the realizability of investment property on the remittance of income and proceeds of disposal. Contractual obligations to purchase, construct, or develop investment property or for repairs, maintenance, and enhancements.
Yes, there are additional disclosure that only affect fair value model and some affect only cost model. Can you pick them one by one?
Additional disclosures for the fair value model. 1, a reconciliation between the carrying amount of investment property at the beginning and end of the period, showing additions, disposals, fair value adjustments, net foreign exchange differences, transfers to and from inventories, and owner-occupied property, and other changes, IAS 40, paragraph 76. 2, significant adjustments to an outside valuation, if any. 3, if an entity that otherwise uses the fair value model measures an item of investment property using the cost model, certain additional disclosures are required. Additional disclosures for the cost model. The depreciation method used. 2, the useful life or the depreciation rates used. 3, the gross carrying amount and the accumulated depreciation aggregated with accumulated impairment losses at the beginning and end of the period. 3, a reconciliation of the carrying amount of investment property at the beginning and end of the period showing additions, disposals, depreciation, impairment recognized or reversed, foreign exchange differences, transfers to and from inventories and owner-occupied property, and other changes. The fair value of investment property. If the fair value of an item of investment property cannot be measured reliably, additional disclosures are required, including, if possible, the range of estimates within which fair value is highly likely to be.
Thank you very much. Okay, that brings us to a conclusion on this length of discussion with respect to investment property. Now, if there are any concluding questions, concern, or observation, let us discuss it as we wrap up this particular session on investment properties. Any further question, observation, contribution, or otherwise?
None at all from my end.
I want to ask, can we consider an investment property as a qualifying asset for the purpose of capital allowance?
Okay, that is with respect to the requirement of the relevant tax laws of different countries. I can tell you vividly, in Nigerian context, there's nothing like investment property as defined for capital allowance purposes. What the law knows is property with respect to buildings. And therefore, you enjoy your capital allowance in that respect over a 10-year period, I guess. Yeah.
Thank you.
You get it now?
Yes,
therefore, tax principles are not always in tandem, or let me say tax rules, because tax are more of rules. Tax rules are not much in tandem with financial reporting rules, especially principles, especially with respect to things like this, or fair value measurement. Today, most tax, except for other jurisdiction that does inflation index or some things to reflect adjustment, current market adjustment. But in most part of the world, and in developed world, especially in Nigeria, there is no tax law today that recognizes fair value, that recognizes inflation index adjustment and some other things. All of our tax regime is based on historical cost and transaction price as it occurs. Do you get what I'm saying?
Yes.
Okay, that is that. Now, successfully, we are able to have extensive discussion on the requirement of IAS 40, and we have successfully delivered on it. Thank you very much, and God bless you for that.